So if you click on this video, you probably want to get involved in the property market. The problem is, most properties are either too expensive or they are at a very late stage in the cycle where everybody is already involved in the market and there's a very high risk of you losing money. So here's how to tackle that in 3 steps. First, we'll break down whether we're actually in a real estate bubble or not. Then, we'll answer the real question, how and if you should still invest. And finally, we'll talk about the risk and how to navigate them like a pro. So if you're serious about building wealth in this cycle, then pay attention. This is where you build your edge. So before we dive in, if you want elite insights on the real estate cycle, stocks, and crypto, subscribe to my newsletter in the description down below. It's 100% free and it's stacked with pure sauce. So go and grab them. Now, let's get into it. Are we in a bubble? Before we answer that, let's define a bubble. The bubble, or winner's curse phase, is the final and most explosive part of the real estate cycle, right before everything collapses. It's when prices go up so much, go so parabolic, speculation goes crazy, and the dumb money starts piling in. And guess what? We're right in the middle of it. But hold on, what even is the real estate cycle? It's the same cycle that has predicted every major crash. The 1999 internet bubble, the 2008 GFC, and even the COVID crash. Discovered by Fred Harrison, a top British economist, it's built on 200 years of economic data and is used by some of the most successful investors on the planet. And even I myself have gained over $300,000 from just using this cycle in the last 4 years. Now let's really connect the dots here. How do we know we're still in the bubble phase? Well, mortgage rates are now dropping fast. US mortgage rates just fell from 8% to 6.09%. In Australia, banks are cutting rates across the board. ANZ just dropped 0.15% down to 6.39%. CBA just slashed 0.15% as well, and NAB just did the same thing with 0.40%. Also, governments are now pushing home ownership like crazy. More grants, more tax cuts, more policies to fuel the property frenzy. And Kamala Harris recently even wanted to hand out a $25,000 buyer grant. And Donald Trump is going full send on tax cuts and even tweaking mortgage interest deductions. And not only that, the stock market is now at its all-time high. If you look at the market Shiller PE ratio, which indicates the market valuation, it is now at a similar level with the 2008 GFC and 1999 internet bubble. Crypto is now at an all-time high, and everything is lining up. This is where the winner's curse phase and the bubble is in full effect. The question is, how do you play it? Let's break it down. It really depends on your own financial state. Look, we're very late into the cycle. You're not going to see massive upside like those who got in at the bottom. It sounds obvious, right? But most people still need to hear it. Let's keep it real. There are limited choices left, but that doesn't mean there aren't opportunities if you play the long game. If you're willing to hold for the next 7 to 10 years, you can position yourself for the next land cycle boom. The 18.6-year real estate cycle follows a very predictable pattern, and the best moves right now are usually in locations that are set to explode in the next first half of the cycle. So where to buy based on that? If you're looking for the safest bets, you need cities with strong job markets and economic resilience. And in Australia, only 2 cities meet these criteria: Melbourne and Sydney. Everything else, historically, they stagnate a lot in the first half of the next cycle. So the next question, what property types really work? If you're a first-time buyer or you need positive gear cash flow properties, focus on apartments, villa units, commercial properties, and single-level town residences. These properties have a lower land component, but they're in very good locations. They can still attract demand and they can generate cash flow. At the same time, they are a bit more affordable, so you don't have to use too much debt. And also, they have higher yields. So in the case of a market crash and you lose your job, You won't have to worry about the negative gearing killing you. However, you have to be careful, especially with apartments. And I made another video about this, so check it out at the end. Now let's talk about risk. The risk of investing so late in the cycle. 1. The waiting game. Let's break it down. Property cycles take time, right? It usually takes around 4 years to go from the peak to the bottom. And you add another 2 years of waiting for the peak of the winner's curse phase. That's 6 years of waiting before you see substantial growth. So if this is not your first property, or you don't have time to invest right now, there are better options out there. Now, second risk, land to asset ratio. Land is the biggest driver of price appreciation. But properties like apartments and villa units have lower land to asset ratios. This means less capital growth. These might still work for cash flow, but don't expect huge appreciation in the land component in the next cycle, like properties with bigger land. Now, third risk, interest rate risk. Positively geared properties rely on rental income to cover their costs. But if interest rates rise, your mortgage repayments can outstrip your rental income. This means negative cash flow, forced selling, and stress that you don't really need. And that's why risk management is key. So if you're investing now, be extremely smart. Pick the right city, Melbourne or Sydney, choose cash flow properties carefully, and be prepared for short-term risk. But if you don't have to invest, wait for the next cycle might be a much better option. So what do you think? Drop your thoughts in the comment section down below. And if you want more insights on real estate, crypto, stocks, and market cycles, do subscribe because I'll be revealing more insights very, very soon.